We're snorting cap rates and shooting up cash flow here at Deal Junkies.
Welcome back to Deal Junkies. Episode almost 100. No
Really?
game. Yeah.
What are we at right now?
We're 92, 3 is going to drop. 94 is going to drop.
Dang.
No idea.
We're in there. We're in the 90s.
No, I think you're right.
No Gabe today because we had snow.
He doesn't know how to drive in the snow.
Oh my God.
Gabe has a very, very steep hill.
Yeah, but I have
3 of them.
No, I offered to go pick him up and he said no thanks. He just doesn't want
He
to come.
didn't trust your driving.
Gabe,
He didn't want you to
Is
get
that what it
trapped
was?
down there. Have you been down to his house?
Dude.
Up to his house, I guess is the better.
Yeah, I know how to drive in snow. It's fine. It's a hill.
So
Gabe's a pretty good driver. That's
yeah.
all I'm getting at.
I'm glad Gabe's not here because he listens to all the episodes. So
Yeah,
this
he's gonna love-
he's gonna love this one.
Yeah.
He's our audience, one of one.
That's
He's
true.
the biggest fan. So this episode's just for Gabe.
Dude, so I went to Seattle to speak at Lake's event Wednesday night.
Oh, was that Wednesday? I was thinking
Yeah.
it was today for some
No,
reason.
it was Wednesday, and I got up early, 4:30, so I could drive back before the snow.
Mm-hmm.
I got 30 miles from Portland, pulled over for coffee, wanted to get my computer out, left my laptop in Seattle.
Oh.
So then I had to drive 2 hours back to Seattle, and then it was a 8-hour drive back, 7-hour drive back.
Wow.
It took me 4 hours to go 5 miles at one point.
You were
That's
speaking
miserable.
with Ryan Gibson there, right?
Yeah,
Oh,
Ryan's
that's
awesome.
sick.
Isn't that dude insane?
Dude, he's
That
mechanical.
guy's a baller.
I don't know how.
Tell us what he does.
Oh yeah,
What you learned.
yeah. So Leica's event. Leica has an event just like ours in Seattle.
How many people were there?
It was about Salem size. Wasn't quite Portland size. I think it was actually probably smaller than Salem now. I think she probably had 60-ish.
Really?
people, maybe
'Cause
70.
Our event's bigger than your Portland one right now.
No, it's not.
just we have over 100.
No, you don't.
Numbers wise.
I mean, if you count the amount of people, then I get it is bigger. But if you look at how big the room is, volume wise, then I guess yours is bigger.
That's true. You guys do have a bigger
You have a
venue.
bigger room, if that's
Yeah.
what you
We
are
just
talking about.
fill it up though.
You guys are just manipulating the numbers. It's okay. It's okay.
By getting more
Okay.
people to show up.
Don't have more people show up. I've been in both rooms.
All right, we count.
I've been in front of both audiences.
All right.
Okay.
Anyways, Ryan Gibson though.
Yeah, so Ryan Gibson, and then
Give a
Wolf.
little background on who Ryan is, because he's a self-storage guy.
Yeah, so Ryan Gibson was a pilot for Delta, and then he built out a huge self-storage company. In fact, I think it's bigger than AJ Osborne's. They have 4.5 million square feet of storage. He's really, and it was an economics panel. So what it was an economics panel, me, Ryan Gibson, and then Wolf works for the AI department of certain lending. It's called Vontiv. So their AI department talking about economics. So that was the focus, but he kind of got into what he does as well. So he's got storage in the West Coast, storage in the East Coast. He dropped a seed about maybe looking to Northwest Arkansas if you want a really good market for upside with in migration and great economics and top Fortune 500s moving to Northwest Arkansas. But, we just kind of talked about the state of the market. They bought $174 million of real estate in 2024. Before he said that, he asked a question to the group. He said, what's happening? Money on the sidelines or what's more prevalent, money on the sidelines or deals? And I said both. And he didn't agree, but then he bought $174 million of real estate. So I don't know.
He didn't agree.
Yeah.
What's more prevalent? Money
cash on the sidelines. Yeah. So that was kind of, we all had focuses. My focus was more like, hey, the Fed's not going to bail you out. And the main slides I showed was, they're trying to reduce their balance sheet, yet the money supply is actually increasing while they're reducing their balance sheet, so my analogy was Jerome Powell is in a boat, a sinking ship, and he's got a bucket to get the water out, and you've got politicians on the sideline shooting holes in the boat. So that's kind of the analogy that I went into. And then Wolf got into really interesting just AI. And this is one thing I've said about real estate is the best part about significantly increasing interest rates and creating inventory is now real estate can get localized again, meaning local demographics should be what drives price, not just cheap money and no inventory.
Yeah.
So he had some really good slides. Like on the macro level, everything looks simple and easy and just stable. But if you actually drill into locations, you can see various significantly different performance in different markets because real estate's got localized now because of the lending market we're in. So that's kind of what he talked about. And then Ryan kind of just tied it all in with macroeconomics of, I think we're all in the same opinion that money is still sitting on the sidelines and kind of waiting. One comment I had, actually multiple conversations last week with other investors and another developer significantly, which is as real estate buyers right now on the development side are valuing opportunity costs really high.
Sorry, say that again.
We are valuing opportunity costs, the cost of doing one deal and not doing a better deal is valued higher than it ever has been. And that's
because there's less money.
No, that's why there's cash on the sideline.
Yeah.
Is because you really want that good deal. And the more that this
you guys are saying the same thing.
Right.
Yeah.
The more this gets strung out from a time standpoint, that value gets even higher because the longer we have duration, the more you expect duress.
I have one. I agree with all of that. I don't know if it's sideline though. I think money is like in the.
It's just allocated.
I think it's in the box seats right now. Like it's in another asset. Like it's not even paying attention to the game right now.
Yeah, it's like their
there's so
slide
many
was
people-
1.7 trillion of venture capital in cash right now.
1.7 trillion of venture capital in cash.
Private equity. That's what it was. Private equity, and the slide was stupid. Heads and shoulders above. Yeah.
That's absurd.
Yeah.
I mean, I don't have a frame of reference, so I don't know if that's like higher or lower than.
Yeah.
normal.
So
That's
for
the
a frame
hard
of
thing.
reference, the slide he showed, it was head and shoulders above recent times and almost at historical levels, the amount of cash sitting on the sidelines. So I think if you look at it in terms of historic, that's not that big of a deal because maybe it was must have been an inflation adjusted slide. But still just the fact that you have more capital. But I agree, money is just sitting on the sidelines and it's getting prolonged.
I think it's tied into assets though. I mean, I think there's people.
It's just allocation.
Like, yeah, we just can't trade right now. Like what I have is as good as I can get right now. A lot of it's just because you're tied into good debt. A lot of it's because you don't want to pull out on gains on the stock market because it's up 40% this year. It's like,
Yeah, but that doesn't explain cash.
well, no, that's what I'm confused about. That's why the liquidity thing is so
No,
shocking to me.
Oh yeah, because you look
I
at everything's
think
at an
that-
all-time high. Stock
Yeah.
market, other than the retreat we've had recently.
Yeah, I'd love to see.
Gold's
that.
at
I
an
don't know
all-time
how
high.
is that
Stocks at an
calculated?
all-time high. Crypto's at an all-time high.
Yeah.
Cash is an all-time high. Well, just look at the Fed balance sheet, right? So when the Fed pulls money out of the economy, they're not pulling it out from investors, right? That's like just a reset of debt. So when they buy debt, they just give investors their cash so they can go invest at. So that's why the money supply is still high because the government's still spending. So we still have a ton of private capital, so much private capital. And again, one man's equity is another man's debt. I just look at the entire world of equity. Either it's in the stock market or the bond market. And so we have more cash, more stocks, more bonds, not more bonds. So that's part of the allocation is money's not as much into bonds, which that does lead. I bet you a big portion of that cash would be in bonds. Did you see was it Elon's tweet that said with the actions the $4 billion they're saving per day in Doge is going to lower yields in the 10-year?
I saw that tweet. Yeah, I did.
Yeah.
What do you think about it?
I think I mean we never should we talk economics? I think
Seems like
we still don't know. Okay, I've done a handful of presentations on economics. I've been on some panels, and it seems like the consensus feeling is no one just knows. And part of that is the tactics that Donald Trump uses from a negotiation standpoint. I think it's very clear now that all the discussion about tariffs and inflation, tariffs are not an economic policy. He is not using them for economics. And if his actions clearly show that he doesn't care about tariffs from an economic standpoint, it's a tool to use for other negotiations from geopolitics. And you look at, he's a businessman. He wants to run the country like a business. What are our two biggest strengths compared relatively to the rest of the world? Our military and our economy. Well, you don't necessarily want to go use the military. So we're going to weaponize our economy. And so he's weaponizing our economy for geopolitical negotiations. With Doge, they're taking significant action, but you don't know what's going to stick. Just like you don't know what's sticking on the tariffs, you don't know what's going to stick on Doge. So sure, they can say they're cutting $4 billion a day, but there's a lot of stuff in various lawsuits and court battles, right? It's really even hard to pay attention and track what's happening. But the other thing about tariffs is he can implement the tariff, and even if he didn't retract it, that's not going to reverberate to our economy for a while. Businesses are supplied for 6 months down the road. So he pulls those off. He can just put them on, pull them off, and it just becomes a battle and doesn't actually affect the economy. I do believe that Doge matters, but when it comes to the 10-year and the short term, you can see all of this. You saw a little bump with the tariff actions when we had the stronger than expected jobs report. Then we got to 4.75. But the biggest movement has been on the inflation rates and the most recently consumer spending. And so I think
consumer spending's down.
Yeah. So lot. Today we're down under 4.5. Yeah. When I looked this morning, it's 4.45, and it was 4.75 last week after we had the inflation reports. Right. Yeah. So that was just a couple days ago.
Yeah.
So the market's moving mostly because of actual inflation reports and, more importantly, expected purchasing power. So jobs and consumer and spending. The PPI came out really hot over expected. Then that's the producers. That's the cost to bring stuff to the market. And that is what the Fed really cares about, is because based on economics, our cost determines pricing. Otherwise, we don't produce.
Yeah.
And so if we are producing, we're assuming there is demand on the other side from a macro standpoint. So inflation came in really hot, rates bumped up, but once consumer spending, it undercut all of that activity and actually went back under the 4.5. So I think
do you want to explain why consumer spending affects?
Because it's just future demand.
Yeah.
Yeah. So now we expect if we're spending less, that means we're starting to cut. So it represents contraction. So that's a report that says the economy is going closer to recessionary type contract.
You think you think the economy is going to go towards?
No, I'm not saying that. I'm just saying there's indicators towards recessions and there's indicators towards growth, right?
Yeah.
So you're either expanding or shrinking. And they're paying more attention to the economy shrinking, or there's more movement. And what I've been watching, it feels like there's more movement on that, aside from the initial blast of the Trump trade and then him getting elected and the movement of crypto. And essentially everything reallocated after that initial Fed cut. Rates got really low, the Trump trade came in effect, and everything got reallocated. And since then, the allocation hasn't changed significantly. That's what I'm believing. Yeah. The market's finally starting to come back.
I think it's going to. Well, the market's been
significantly came back, freaking right after the Super Bowl, and this is why we say the Super Bowl.
Do you mean the real estate market,
the single-family real estate market, the residential?
Gotcha.
Like Ryan Heltemus was on. He's like, Mike told me January and February are the best markets or the best months to sell real estate. Historically, it's February. January was slow. A lot of that because of the allocation figuring its way out to the marketplace, but everything, there's my realtor calling multiple times right now because I think we have a multiple offer situation.
You should answer it. Let's do the deal.
Oh, all right.
Put it on the mic.
Tim, you're on a podcast live.
Oh, nice. How's it going?
It's going great. What's going on? Do we got multiple offers? We were just talking about the market picking up.
Yeah. I mean, there's somebody else going to check it out for a backup today. Are you able to talk about Joe and Yvette real quick?
Let's hold that for not a live episode.
Not live.
Yeah.
Okay.
We're trying to talk deals, Tim.
Yeah.
Well, it's a live deal.
They're hot to trot right now, but they're asking some questions on finance. So just let me know when.
Go 20 grand over list. Send it in.
No, we're in escrow and
I'll terminate it.
Yeah, we'll talk details later, man. All right. But yeah, let's get some really high backup offers. We appreciate that.
Oh, will do.
All right. Bye.
All right. Thank God he broke up the econ talk. Let's talk
That's
deals.
super weird.
Let's talk deals.
I didn't know you had a realtor that wasn't.
Oh, dude, most of our stuff's pocket listings.
Us.
Because that's what market conditions allow.
Okay. Mike, we wanted to talk about the deals you're doing right now. You said you had
Dude, I just was talking about the deals. We're selling stuff.
We don't want to talk about those. I want to talk about what you're buying.
Dude, you can't buy if you don't sell.
You can. What do you mean? Tell Paul Curley that.
Jesus.
It's true.
Paul Curley works on different time frames. I'm just a shorter time frame. If you take what I do and 10x the time frames, it is Paul Curley.
I don't think
It's
that's
just
how
different.
that works.
Well, maybe not because he never sells. I can't say that at all. That was a completely
That was
false.
bold.
That was bold.
I'm gonna level with you.
That was. I didn't. Yeah. Oh, wow.
So
I honestly, for a second, I was like, okay, let me think about it, and then it was
yeah.
like,
Nothing about that was truthful.
So you said you had 17 units under contract and there are 51 going under contract, and I want to figure out how you're doing this because I want to buy deals and we have none under contract.
We have another 57 going under contract.
It's not under contract. So tell me what you're buying,
he
how
said
you're buying
going
it, and
under
why.
contract.
Tell
how are you
me
buying
about these deals.
Are we fighting over the same deals again?
No,
No, I don't think so.
certainly not.
Certainly not. What makes you say certainly not?
You're just you're not trying.
I gotta qualify this conversation.
No, you're not trying to buy this deal.
No, I want to make sure. Why do you say certainly not?
Where's your deal?
Where's your deal?
Not in Portland.
It's not important. Okay, it's not
Not
the same
in
deal.
Portland.
Okay.
Yeah.
All right. So we've got 15 apartments in escrow, seller finance deals. These are unique because they're the most I'd pay for per unit. They're like in place rents, beautiful security, turnkey. It's not anything I typically buy, but it's an ender. So just and more pocket listings.
What do you mean it's an ender?
An ender. So enders will eventually get there, but enders want to seller finance their real estate.
Oh, it's an old guy.
You know, it's an older guy. Yeah. So he owns a portfolio, and then he's now starting to end his career. And some brokers approached him, and I love the first conversation with the seller because I didn't talk to the seller until we were in agreement to not buy one but two properties, and they went into escrow like a week or two after each other. And then, the conversation was, his statement was, I always get nervous, when brokers contact me. But they were smart. They understand seller finance, and they knew we like seller finance, and had been wanting to bring us a deal. So we put a deal together for one, which is an assumption. And then when we got that inked, he was like, well, let's do this other one.
So you closed on it? Or
No, we're,
contract?
we just went escrow in January.
So what are you paying for these? What do the terms look like?
They're over $200,000 a unit.
Okay.
How big are they?
They're nice, just to your typical Unitarian 2-bedroom. What is that word? Totalitarian, Unitarian, uniform?
I don't know what you're talking about.
2-bedroom, 1-bath apartments.
So like 800 square feet.
Yeah, I like them because they're multiple buildings on multiple lots. So they have good lots. They have parking. Like I said, he's done the envelope. So the siding, the roofs,
What
the
do they
windows.
rent for per unit?
One building, the first one is more like in the 1600 world right now, and they've got some upside.
Okay.
The other one, it's crazy. It's not a great part of town. I really actually don't like the location. But the rents are top of market I've ever seen for 2-1. So I'm a little nervous about that.
He probably doesn't screen the tenants.
Yeah, I
They're
don't
just
like
sex
that.
offenders.
No, I know this.
I've seen that one time.
I haven't confirmed that this is someone that I know of, but I think I've had other friends manage their portfolio. So I understand a little bit about their mindset.
So what cap rate are you buying this at roughly?
They're in the 5s. They're not too bad.
Okay. And then
What interest rate are you?
They're market rate. They're maybe a little bit above market rate.
Okay, so
here's what was really cool about the deal. So we don't know anything about the seller, and brokers, I'd say this, even these brokers, they can do a much better job of understanding what information to give us to make a offer relatively blind. So in this scenario, they did have rent rolls, they had information, but we didn't understand what terms were other than we knew what his price was. And on the first one, there was a bank loan that he wanted to be assumed. And so everything else we were flying by. So I offered $100,000 down and then a 10-year note. And of course the rate increased so we could absorb. He countered back with $200,000 down, but then he wanted to extend the note to 20 years.
Oh,
yeah, this is what, and so this is where it got really exciting. So he wanted to extend the note to 20 years and then defer year one of interest, wrap it into principal, pay it out at the balloon.
So increase price, and how do you wrap into principal?
Yeah, so that's how you increase the price essentially, is you convert the first year of interest into principal.
Okay.
I don't know if
So
that's
no
legal.
payments the first year?
Yeah. Except for on the assumption there's bank payments.
Yeah.
But that just juices your first year of return.
Sure.
And so in this scenario, it's perfect for one of the capital partners I'm working with where he needs to place capital. He wants to get it out of the stock market into real estate. He's a real estate professional, so he needs the tax savings. And this way we can juice the return. And so he can get income, but the way you structure the partnership in an LLC is he's making a huge capital contribution and we're just returning the capital, so that's not income, so he's not getting taxed on it.
Wait, repeat that.
He's making a capital contribution to the
your
LLC,
partner.
the partner, right?
Yeah.
So we're forming a partnership. He's bringing the capital to the table.
Okay.
And then we juice the return by repaying down his capital account. So he's not actually getting income. So he's making an investment. He's essentially getting income back in the way his mind thinks, but he's getting the huge tax benefit off the top of it as well.
Because he's just taking accelerated depreciation or something?
No,
Or
because
what-
it's getting.
We're taking
he's
the
putting
accelerate,
money in, and then he just gets his money back out.
but it's
Yeah,
not
It's a
income.
capital account. Yeah, so it
But
doesn't count as
and where's
income.
his money coming from? From the stock market?
Yeah.
I mean, he's paying tax on that money he's taking out of stock.
I don't know about his basis on the stock.
I don't understand what you're saying. I guess I don't understand the advantage. understand he's putting money in and getting it back out.
Yeah, but instead of putting it down as a down payment and
Yeah.
then saying, "Hey, he put in 200K, now he's going to take 200K out first, like first in, first out," but you still have to pay tax on that income. They're viewing it as putting it into a capital account, which is like we did that on
Yeah.
the project in Astoria.
Okay, sure. Okay.
Yeah.
So
It's
he's
just
making
better.
an investment in his mind. Like, think about it. Investors think about their cash flow, right? So he has a store of value. He's going to get his capital about, but you can he's getting it back as a non-taxable stream of income in his mind, the way it's structured.
And so you're buying all these for like what, 3.4 million total or something like that, and then you're buying it with $3.4 million of real estate with $200,000 total dollars.
No, it's 200 per deal.
Okay.
Yeah.
So 400 still total.
Yeah, it's over 10%. It's like 15% is what it points out to. It's
and
a little over 3.
And you have one partner on each deal giving you
Same partner.
Oh, doing both.
Mm-hmm.
And what percentage of the deal does he get to own versus what you own?
We're still negotiating that portion of it. Yeah.
Okay. Because you'll get to own a pretty big portion if he's pulling his capital out first.
Yeah,
too.
we're talking about 50-50. It's just structuring it so he's comfortable with the 50-50.
Okay.
Yeah.
So, and then what interest rate then, like specifically, do you have on the?
On the seller notes?
Yeah.
They go up to 6. They start at 3.
This sounds great to me.
I'm happy with it.
How long are they at 3 for?
Not long. They go to 6 pretty quick. So we're done with due diligence. The one building had an illegal unit in it that's kind of being figured out and discussed right now. I'm not a fan of the assumption because I don't know that the
Bank will allow.
that part of it, especially with a seller second, because that's his he wants to the second he wants to double collateralize, which I'm fine with.
To some other stuff you own?
No, to the other deal he's selling us.
Isn't he? He's
No,
gonna be in
because
first
he owns
and
the other one
second?
outright, so he'll be in.
He owns one outright, which is so 15% down, 85% seller financing.
Yeah.
The other one is like 10% down, bank assumption. He has a second, but he wants to cross collateralize both of those properties
If he's already in first, why would he cross collateralize them?
to protect the second on the bank loan.
Explain that more.
So if
He's
the-
not
if
cross collateralizing the first; he's cross collateralizing the second. So he gives
Yeah.
the second that's in the assumption.
Yeah, behind the bank.
So,
loan.
so,
Yeah.
but since he has the first on the other property, he knows that he's not going to screw himself out of the second if the bank ends up like foreclosing and he has to go through this.
Oh,
huge
he's putting
process.
another second
He's
on.
putting another second
Gotcha.
on
Behind the
the other
bank.
property.
Well,
yeah.
no, behind the bank and behind his first on the one he's fully carrying.
Yes, correct.
Yeah.
So that
So then if the one on the bank loan gets
Bank
screwed
loan.
He
up,
just
it
wants
has
more
the
protection
then
for
he
the
still
second.
has a
That makes
second
sense.
on his own
Sure.
first.
Yeah.
And then how does that work specifically too? Because you can just have a second lien position with no note attached, essentially, because he's not taking payments on that second or anything. It's just a collateral position.
Mm-hmm.
So it's just stating I have collateral for X dollar amount, probably the remaining equity or more, right? So it's over collateralized.
About yeah. That's one. That's definitely one way to look at it.
Yeah. Okay.
Yeah. Until we increase the rent rule.
Okay.
Do you think you'll be able to on both of them? It sounded like you weren't super confident on one of the properties.
Yeah, but that's the one where it's 100%
Over
seller
20 years, he
financing.
probably will be able to.
Yeah, I'm not worried about that.
Yeah.
So and then further,
I just mean before it hits 6%.
yeah,
if you're
so we
buying it
could
at a
we
5
can
cap.
further explain the deals. So the 9 unit is the bank one. The 6 unit is the free and clear. The 6 unit's the one that's has rents that seem really really high because of the location. However,
Goose Hollow.
Goose Hollow seems like it should have some of the highest rent in the market. However, right now it's probably depressed. Are you doing a deal in Goose Hollow?
No, there was just a 9 and a 6 unit in Goose Hollow,
Oh,
but we're not doing it.
those are probably not $200,000 a unit. If they are, they're studios.
Yeah,
Yeah.
they were
Yeah, I don't buy property in Goose Hollow. Fuck that.
too expensive.
Why are you dropping ADHD bombs, buddy? We're trying to talk about a deal.
My bad,
All right,
my
so
bad.
going back to the 6 unit. So at one point, and I didn't know. So when going into the deal, I thought these are big units. It's 3 units. They're duplex units. They're aligned. They've got parking. And I knew the seller. I knew that he liked nice envelopes, nice settings. And I thought, well, this price is really good for a condo conversion price, and that's a great exit strategy. So there's potentially a way to recoup capital there, or a way to. So that's the whole thing. Is it's a great place to place capital for a few years when rates are low to juice the returns. But after that, in order to get capital back, we need to do something different.
Is there a prepayment penalty on your note? Or
Yeah, 5 years of prepayment penalty.
Okay. Why did he extend it to 20?
Because he understands that it's a business relationship, and he understands we'll be modifying that note down the road. So he's a seller that will be refinancing and selling and moving his note from property to property. So I don't look at this like these 2 deals are great purchases. In fact, the bank assumption is not a great purchase. It actually would be negative cash flow. It would juice down the
You
returns
shouldn't tell your investor it's not a great purchase. We'll send him this episode.
based on how I like to
kidding.
force value.
I'm just kidding.
Right?
Just kidding.
So that deal. But I don't see this as 2 purchases. I see this as potentially 5 to 10 to 20 purchases. Does that make sense?
Using his note.
Using his note.
Okay.
Yeah.
Yeah, because in the 6 unit, there's exit strategies. But one thing we could do with the 6 unit, because it does have good income stream, is we could just go get a bank note relatively quickly. We're going to owe him just over $1 million. We can go get $1 million refinance, and then just use his $1 million in his note to go buy something different. Now, we need to establish the relationship first, and we need to season that, so that's not in the plan, but that's the tool that I am looking at. It's just a matter of what do we do in the interim before we truly access the benefit of the deal, which is the relationship that we're creating. And what was really interesting about this is the second deal is contingent upon the first deal closing.
Is the first one the bank one?
Yeah.
Have you talked to the bank yet?
No, because we have this illegal unit that we're figuring out, right? So
They won't know it's an illegal unit, will they?
no, but I need to figure out the assumption, like the income of it matters when it comes to the DSCR. And my concern is what are they going to stress test it at? So I wanted to get through due diligence.
I don't think it will matter if you're assuming the loan and they already lent on the property.
Oh,
Like,
dude,
it already
no, they're going to
DSCRs.
underwrite. I need to understand their underwriting before I just start wasting money on a potential assumption, because it's like a 1.18 DSCR with a 3.4 rate, and then it's
Because
a
you're worried
variable
about the
note.
second, not
No, I'm
DSCR.
worried about the variable note. It's a variable note that it changes this year, and it's going to bump close to 7%.
Oh,
Yeah,
I see.
But it's also 5 years into the note and has a decent amount of principal paid down at this point. So it doesn't make sense to get a rate slightly less. It makes sense to hold the note for a
Get
period
rate
of time.
at like 6.25.
Yeah, but you have to pay
elsewhere.
points to go do it.
Right. So
No guy for you.
yeah, if you look at the short-term math, it makes sense to wait until rates get under 6% and then you refinance then. And plus, we can get the income stream up. So the goal isn't to refinance out the 1.2 that's there. It's to refinance the 1.4
Why don't you
that we have
just
into
skip
it.
that part and do like a master lease or a wrap? Or
So that's the discussion that we're probably taking this. We've had some conference calls on the unit, which is going to be a nightmare. So our income's less.
nightmare.
Nightmare. So that income was
for that.
that income was analyzed when we made the offer, and so there's just now we need a discussion. And I think the seller just needs, and I'm trying to make him comfortable with this, to understand is like, I don't care about the price. I have no desire to change the price. It works. The higher price benefits you and us in the long term of what we're trying to do. Let's just change the interest rate to affect the value that we lose here. Better yet, let's juice it so we take that entire value not over 20 years, but in the next 3 years. So that's just a discussion that we have. I think what that will probably ultimately be is either a land sale contract or probably a master lease option on the bank loan. Because I don't think we're going to get approved for an assumption without paying the note down, because once it adjusts,
Won't DSCR.
if they stress test above the adjusted rate, there's no way it qualifies.
No. So you were talking about using the note in the future to go buy other properties
Yeah.
with it. Awesome. We
Yeah.
love that.
Love it. It's my favorite thing to do.
Park and collateral,
Yeah.
other places. Here's the thing, though. On a land sales contract, you can do that?
No.
Oh, okay.
And I just dropped a seed. I haven't even talked to the seller
Yeah,
about
you'll
it.
be able to
I-
eventually.
So what I said is we'd have the land sale contract have verbiage that it would get converted to that the note would get created at the execution of the contract.
Oh, so you can you?
I don't know.
If you already have a land sales contract in place, I'm asking very selfishly because we have a contract from guys who I think would let us do. We were actually talking about them this morning. Who I think would let us do this in the future at some point, especially if we were like, hey, now you don't have to get taxed on it. We're just going to move it somewhere else, and we'll give you like an extra 2%.
Yeah, for people that are listening, this is how ideas are created. I have no clue.
Yeah.
But it makes sense that they've already done a land sales contract. They may or may not are showing an installment sale on their tax return, depending on who they are. The land sale contracts I've done, which are few, they've reported them as installment sales, but you can execute that contract, and instead of cashing them out, you create the note.
It's never received.
And then the installment sale treatment just gets extended on their tax return.
There's got to be a way to do that. You probably have to put it. You probably have to like put it in a trust or something. There probably has to be something funky done to it.
I mean, you can always ask people to figure it out.
Yeah.
But there has to be able to happen.
Yeah.
Otherwise, at least a master lease option is a great way to do it. And then he has other properties that wants to sell, and so we're just creating a relation. I don't know. Maybe I'll refinance that one and buy one of his other properties with some of that cash.
Okay, that's cool.
Yeah.
And
so, but I didn't finish the story. So those units that seem like they're above market rent, they're 900 square foot, 2-bedroom, 1-bath units with in-unit washers, and each unit is on like a 3,000 square foot lot. So they have these huge fenced yards.
Oh,
They're
like
actually
round
for at
homes?
least 1,200.
Are they like townhomes?
No, they're one level, 900 square foot, 2-bedroom. They're 4 condos. And so I meet the guy. He's like, "Oh yeah, they were condos when we bought them."
And then he
terminated because he didn't want 6 tax bills.
Yeah. Okay. At least 1,100 you could get for this.
No, they're like 1,800. Dude, he's getting he just rented a unit at 1,825.
Trevor's had
I'm
too
trying
much
to mess
caffeine.
with Mike, and he's just not having it today.
I'm ignoring it because I'm excited about my deal. You got me all excited.
It's a good deal.
So those could probably, I think we're $220 a unit on those, a little more, and they're probably $350 as condos.
If you saw them,
Yeah.
That's cool.
What about this 51 unit you were talking about?
Tell us about
What about that deal?
Those are just more pocket listings that are just offers that are in the ether that are being considered.
Yeah.
One of them is probably earnestly being considered. One of them is they already countered with some not too realistic terms. But another really good solid building that is just what they want from a price, they're not countering. This is different. So they want higher interest. But the price seems really good. Like the price is $1 million less than what the county has it valued at.
That's usually pretty good.
Not in this part of town.
Really?
Yeah.
County values it high.
Yeah, this isn't a part of town.
I've seen it. The county has it.
This property has high taxes, and so when you actually look at the NOI, there's parts of town like the west side, your NOI is not great because the taxes are so off base on that part of town. So that one, I don't know. Maybe it's a good place.
To buy these conventionally or seller carry?
These are both seller carries. Yeah.
Do you buy stuff conventionally ever?
Rarely.
Really?
Rarely.
Yeah, I mean, the past few deals, he's been all wrapped.
I can't remember
carries.
the last time I went for an actual conventional loan at purchase.
Wait, for what about for flips? You're using
hard money.
Hard money. Oh,
Yeah.
okay. Yeah, okay. Sorry.
Yeah, so like my credit report, it's full of credit checks and no notes because all my hard money. So
yeah,
and I saw one of my
fair.
friends in Seattle who because you have 3 hard money lenders, 3 pulls a year or 2 pulls a year, and the problem is you don't have loans on the back end to show for that.
Mm-hmm.
And then if you other credit checks for other lines of credit in your business and yeah, so I don't have it. Like if you look at my credit report, I don't have any conventional notes.
So you're going into way more multifamily now.
Yeah. Isn't that what I said?
Um,
Isn't that what the whole plan of last year was?
A year ago, yeah.
The pivot was to do fewer flips, and the only flips that we are doing are short term. And so it's all happening.
Are you doing luxury flips still?
Yeah, 1 a year.
Yeah.
Yeah. So we have a bunch of flips on the market now, which was a bunch of long ones finishing up and a handful of short ones that are finishing up. Some are pending on the back end. 2 have sale failed. Fucking sucks. Still building, but pivoting to build to rent. And then I do like the luxury flips because specifically Travis, do you know Travis? From Dallas. I don't want to say his last name because I don't want people to go hire him. But he's just a really good contractor that will come up to the like Lake Oswego area. So he's done this is a third project in Westland Lake O area for us. And he's just so easy to work with. Just does his stuff great. Love his draw process. I visited the property the other day. He makes decisions. He figures things out. We're going to take out the staircase. Then we're going to keep the staircase. He already ripped it out. He has a plan. We're going to widen it. He already raised the floor to the right level. I go and he's like, hey, we're going to move this ducting. He's not doing it, but he's like, hey, we're going to bring it to the kitchen because I think adding 8 inches here, shortening this wall between the kitchen and the entry by 8 inches so you can see the visual effect, and then tuck the duct on the other side of the wall into the kitchen layout.
I'm glad I don't flip houses.
Oh, Max, changing floor plans is the way to create value.
Really?
And it's always the tiny little changes. Like we took a wet bar and converted it to a laundry room off the garage. Like there was a bedroom/den that had a door to the garage. And then on the other side of the wall was this wet bar that looked out over this family room. And so we converted the wet bar to a utility room and took that to the garage, to the door to the garage, removed the door to the bedroom. And so now it functions better. We created a huge master suite, put a sauna in the basement.
Oh, that's cool.
Dude, $400,000 remodel? Hell yeah.
I just live in places with no furniture ever, so I don't have the vision for any of that.
Oh, no, you hire people. I don't.
Yeah. Oh.
Yeah. You say some things
We
and then you
just
let them
hired
figure
Chad.
it out. But 1 or 2 luxury flips a year. And but I wanted to be much faster with how we're doing things, other than those really luxury, like because they're higher profitability.
So with buying more multifamily, what's your biggest constraint? Is it money or deals?
No, knowing how to form the capital. Like I'm so rudimentary. The biggest change I need to do is change my sophistication level of financial models.
Yeah, like what you're paying them in returns, what the share class.
Yeah, how it's
dealing with
whatever
that.
the water, like, because I'm not a syndicator and I don't want to syndicate, but I do want partnerships. And so I need to have a very clear understanding. And so right now, like my pitch decks and I call them narratives because they're so sloppy. They're not professional. They're not polished. They're probably overkill. But for the people I've raised capital from, it's been so relational that I don't need anything sophisticated, but that will run out. And so I do need to get
How much capital have you raised over like the past 12 months?
It would be 1.7 with these 2 deals. It'd be 1.7. No, because then the other 3 deals I did last year was another half. So like 2.2 in partnership.
Okay.
Yeah. And then I bought a single family and a duplex that were next to each other that were just like land bank plays. And they're not even covered land plays right now. 5-year seller financing and then private debt, which is why it's not a covered land play. So private debt to reposition them. And then I'll have to pay that private debt off, which I'll do through a sale in my portfolio this year.
So have you been learning about how you're structuring the debt and partnerships and all things like that? Because there's a lot of ways to do it, as I've been.
Yeah, but I still think like I'm the tip of the iceberg.
Yeah.
And I mean, I started creating, our first partnership was in 2012. Like it's not that I'm not experienced in it. I'm just not experienced in pooling capital.
Yes.
Yeah.
Yeah.
That's the biggest thing I've been learning lately is because there's all the creative deal structuring, which you already know, but then there's the creative capital structuring, which is a whole nother side to making deals work, which starts to get pretty insane because everyone has different needs with their capital.
So where my thought has been is where's the best place to get educated on this and not get sold? So I like the real estate guys. I was thinking about going to their syndicating conference this year.
I was telling Dane to sign up for Tim Bratz's mentorship. He's like the East Coast syndicator, and I just watched the content that they put online, and they just break it down so simply, like how he's doing share classes within the syndications and
so
things he's
okay, I need to stop being a pansy ass.
Yeah, you do.
Okay, so in my phone, dude, this is why I love golf.
All right,
I'm the one with ADHD.
Okay, do you know it's not Fairway America? What's the big multifamily syndicator nationwide? They've got a few billion under, and they're local.
Big multifamily.
Local to Oregon?
The owner is Cassidy something. He's out of Lake Oswego.
Don't know.
So they've got like a $3 billion
Yeah.
national syndication. Most of it's in California. Dude, I met him playing golf. Like during COVID, early in COVID, a freaking Muni course in Portland with bird poop all over the course. I got a golf with the billionaire. I don't know if he's a billionaire, but that was pretty fun. But when I was in Scottsdale, I met, he's a syndicating coach for, what's that big syndicator guy? No, Brad Somrock. I think he was with Brad Somrock's company, but he's a syndicating coach. And I have his phone number because I played a round of golf with him and his wife. So I will just call him and see if I can go fly down to Scottsdale and get some mentorship.
I want to go to Scottsdale.
Yeah, take Dane with you.
Yeah, can you take Dan with you?
Scottsdale's great.
Well,
Such
also,
good golf.
we need to,
Learn
we're in
more.
the same boat as you.
Yeah.
We need to be better at structuring this. And it's not that, like,
Maybe I could go buy a day of his time for us.
given enough time. Well, I was hoping we would split a day of his time.
Yeah.
But that'd be cool. Yeah, because we're moving that direction, and it's weird just like hearing people's feedback on the different structures that we propose.
I would say this. I bet you the best deals and the best structures are the ones we do not see. So like that syndicated model that you see every, whatever they call it, their deal narrative, the best ones are not structured like that.
Yeah.
The best ones are behind closed doors. They're not. I think you use a syndication to create an accredited investor list to create relationships that you do different deals with some of those people. So I'm not going to say this is how it happens, but my assumption is you get the omnipresence, you become the magnet, and then different buckets of capital contact you in a different way.
That's the current goal. Yeah.
Yeah, because I don't
just
like a
takes so much
syndication
time.
model. And most people I know don't like a syndication model.
I like single asset syndication. I think we'll keep doing that for at least the foreseeable future. Given our cost of capital from investors goes down, and by that I mean expectation of return. Because right now it's first big project is coming out.
Yeah,
of the
but
ground.
is that more a market conditions thing or is that a formation thing? Meaning the less expected return.
Oh, I think it's. I mean, part of it's market condition, and then part of it's also just recognition of us. Because right now it's like everybody who does this project with us at this return is going to be like so amped up on it.
Yeah,
and
and I
every deal that we do in the future, it's like, hey, here's this, and they're like, oh,
Here's why I'm different. I see it differently. I have an in-house project management, essentially construction team, where I think you guys hire construction out. No, you keep it in-house?
yeah, it's in house.
Do you take fees for that? Do you?
We're pitching our fee on this.
Okay.
It's heavily reduced.
Yeah,
and it's
so
all. I mean, budget.
The partnerships I've created is the partnership is me, and I put staff in these as well. But you're getting the team, and they're working for free. So other than the fee management, once it's operated, we're going to manage it on a fee contract. But the project management is not coming with a fee, and I'm not marking up the reposition period. Does that make sense? So I structure deals so you get your capital back quickly and you create a return on equity or an equity multiplier.
Yeah.
But we're not creating income during that period of time.
Yeah.
We're working a lot for free. Sure. And we're bringing the deals that allow you to get recapitalized with an equity multiplier.
Our perspective is, hey, if this is the return that we're targeting for you while we're taking a fee. These are the fees that we're taking.
Yeah.
We will forgo these fees so that we can hit these returns for you if need be.
Yeah.
Right. And we don't intend to have to do that. And I'm not saying that like that is great. Like I don't think either way is right or wrong.
Well, the difference is you're looking at it from a return. I'm looking at it from a deal perspective. Does that make sense? So you're looking at it more from the capital perspective. I'm looking at it as I've got this deal. I've got it negotiated at the best point possible. And I know it's a great deal. And I want 50% ownership. So here's how we're going to structure it.
Sure.
And, you know, I don't do the types of deals where you're getting 6, 7, 8%, 10% pref, especially not along the way. Which is these two new deals are actually bringing one of the capital partners along from the two reposition deals, which is one of the reasons he likes it, is because it supplements that those don't have income right now. There's just no income there. So then do you pre-raise your fees then essentially? So you raise enough liquidity to pay your fees before the income comes in, or are you taking your fees at a different time?
Construction just comes through the budget. And so that's just drawn throughout the
And then you
project.
have fees in the budget.
But then the only other fee that we have is an acquisition fee.
At the time of funding.
At the time of funding. And we have to raise that. But it's on the OM. Everybody knows what's going on.
Right.
And we're actually not even...
So you're not taking fees during that the development period. It's construction.
We're not taking fees. No, the GP is not taking fees. The
construction company is hired by the partnership. Yeah, and that's what I'm saying.
No, we are the construction company.
Sure, but
the construction company is in the GP.
Oh,
yeah, it's part of the GP.
But they're getting paid on the contract, not the GP. Or are
Correct.
they? Yes.
No, they
Correct.
have a
Yes.
they have a contract.
Yes,
Correct.
that's correct.
But they can still.
So it's,
yeah,
and I guess
I
what's
see what
different
you're
for me is I hire GCs,
yeah.
and on top of that, we have the in-house team that does the entitlement work. Does that
We
make
have
sense?
that, and we're not getting
Okay.
paid for that. Yeah.
Okay.
So it's
we're aligned in how we do that.
Yeah, certainly. And that's part of, that's part of like prepaid fees.
Yeah.
Because that's just all out of pocket on our end. And all that work is, value, I guess, created that is on this one is going to be just purchasing shares of the LP. And so it's saying, hey,
The GP
hey,
is both.
lender.
Yeah.
GP is purchasing shares of the LP.
The GP
through
has
this.
two classes of ownership.
The GP can only there's only two share classes, and it's GP and LP. And so we're using those prepaid costs to purchase shares of the LP.
Yes.
But it's no different than any other LP owner. It's just coming from a different place.
No, that's
I
how-
guess if
that's-
that makes.
I haven't seen a syndication structured differently than
Yeah.
that.
Yeah.
Yeah.
Certainly in share classes, and I think in the future we'll have different LP share classes.
Yeah. Yep. Tier 1, tier 2 type stuff.
Yeah, I think we'll end up having 3, frankly, and the next one will probably be 2 because it'll be on a value add deal, and I think there's definitely some
So in that,
upside
you
to having a
do-
pref, and
like-
then you finish.
Yeah, step back. So you already funded Seaside and you're moving forward on Seaside, 66 unit new construction, but you're
Yeah.
still raising on Seaside, right?
Yeah.
No, it's not
yeah,
funded yet.
sort of. It's not funded yet. We haven't closed it, but
Oh.
we have the.
You have it.
We're gonna close it.
You have
It's-
enough
I
raise
have
to close, but you haven't finished out the raise.
Essentially, yeah. The money's got to hit the account still, but
Mm-hmm.
we should be good.
Well, this was also weeks ago where that question was spurred.
Yeah.
So, but you don't raise post close
We might,
Okay.
because we're taking. Just because of how much we're putting into it,
to get
the
your shares
GP is
back.
going to have a lot, and so there. And then we might end up raising just to get our money out. It depends. I don't know. I think we're happy to have the money in there, but there might be a scenario where we have an investor who's like, I'd rather see a project that's, on new construction that's like 6 months down the road instead of,
And then you can get some liquidity.
yeah, and then it's like, hey, instead of putting, your money
aren't
in,
your shares more valuable at that point? Can't you,
you can
create a capital
sell them at a
event?
premium.
Yeah.
Yeah. Not even a premium. You can sell them at a markup
Yeah,
because they're
a
worth
capital
more.
event.
Yeah. No, so there's that's happened on other projects too. And I can see it's happening right now, actually.
Yeah.
In order to fund this project from other investors, though, where the other investors are like trying to sell shares so that they can get into Seaside, because it's a good project. But yeah,
And you guys are in tertiary markets, so you have higher returns.
we love it. Yeah.
Yeah, but it's harder to get your loans.
Yeah.
Yeah.
That's the if
Everything is just a
if
trade.
it were easy, then it
Yeah.
would. Like,
That's why you get higher returns.
That's the whole thing.
because
Yeah.
you have to work harder to get those returns.
No, and it's
Yeah.
definitely been a bear, but that's why it's a bear, I guess, is because it's worth it at the end. But man, I want to break ground on this thing so bad. I'm so ready for the construction guys to just go do their thing on it. And the next one's going to be easier. I'll say that too. And part of this is a very, very tertiary market, and that scared some lenders, frankly. Most of the lenders we approached, they were like, hey, you're in a tertiary market where you already have like this many units, which is good, but also like you're super exposed to that market specifically. Like, and so that was a conversation with a couple of lenders. The lender that we're working with now isn't concerned about it because they see the vacancy in Seaside. They see the rents in Seaside. Vacancy in Seaside, Astoria, like that North Coast area,
Like 1%.
it's lower than anywhere else in Oregon.
Yeah.
Nobody can build out there.
Astoria, the income there is it's pretty insane. Astoria's income.
Yeah.
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 You wouldn't think a sleepy Astoria, but
No. I don't know what's in the water
it's
out
the
there.
Goonies treasure. It's the Goonies treasure. It's just
Yeah.
embedded into that community.
No, it's something.
Yeah.
But the rents in Astoria are surprised us.
Well, and the incomes versus the prices. That's what makes that a great market.
Yeah.
But it has less liquidity because it's a tertiary market, and that's what creates lower prices. That creates the income to price ratio that makes it good.
Yeah. And right now there's 2 builders in that market. There's just nobody that's
And hardly
putting-
any multifamily construction.
Well, that's what I was going to say. And one of the builders is only doing single family stuff.
Mhm.
And so it's like, Nobody's putting units up out there.
Yet, is there a bigger complaint anywhere in Oregon about Airbnbs taking away long-term housing anywhere on the coast?
Then in
Than the
Astoria
coast,
Seaside?
yeah.
No.
Specifically from Lincoln City North.
That's what I would say.
Yeah.
Yeah, because I don't think that's like a...
It's not as big of an issue down south coast.
No,
Yeah.
I don't think so.
Yeah.
I don't think people in Gold Beach are like, please,
No.
please,
Dude,
Florence.
I was looking
people
at-
of Florence are tired of... I mean,
I was
you've
looking at
never been to
Airbnbs
Florence.
in Bandon.
Yeah.
Dude, $100 for a freaking sweet unit,
Yeah.
new construction on the cliff overlooking the
That's
ocean.
so funny. We have a bachelor party in May.
Yeah.
And at Bandon.
In Bandon?
Yeah, and we were looking at Airbnbs
Yeah.
and for like 8 dudes.
Yeah.
And I was like, what in the... It's so...
Dude,
cheap.
so very affordable.
Staying in the
at
resort, Bandon,
Yeah, different
and then
story.
park your car, take the shuttle has so much beauty and value to that.
Yeah.
But it's not worth the $600 more per night.
No, but you know what's really cool too? Driving 10 minutes and
yeah.
staying somewhere super
Do you know what's
nice.
funny? I've never actually gone south of the course into Bandon.
Really? That's so funny.
Okay,
We got sidetracked.
Yeah, we're done. The time to go.
Trevor's
I'm
bored.
of this conversation.
Okay.
We were supposed to talk about Gabe.
We were just having fun. I feel like this was great.
Oh,
Mike
Trevor
and I were
wants to
just
talk-
catching up.
We were. It was just a good little, hey, here's
It's good to be back.
we're back.
Also, we get a lot of good feedback on just having conversations.
I've learned that some people like some conversations and other
Yeah.
people hate the same conversation.
That's true.
And you can't please everyone, so we don't think about it anymore. But if you want to come in and talk about deals on our podcast, we're looking for more people who want to come on and share their deals. So DM us on whatever you see this.
DM
stuff
Trevor.
on. Any
Yeah.
of us.
We should probably
Go
say
for
the
it.
same message at the beginning of the next one.
Whatever. All right, thanks for listening, guys. See you later.
Abrupt. Whoa.
Love you too, Trevor.